Welcome to Inside Active, a podcast about active managers that goes beyond sound bites and headlines and looks deeper into their processes, challenges, and philosophies in security selection. I'm David Cohne. I lead mutual fund and active research at Bloomberg Intelligence. Today, my co-host is Christopher Cain, U.S. Quantitative Strategist at Bloomberg Intelligence. Chris, thank you for joining me today.
Thank you so much for having me, David.
So you wrote a recent note about adding profitability to value stocks, or the profitability factor. Since our conversation today will be focused on quality, I wondered if you could give us a sense of how adding that profitability factor to a standalone value strategy performs.
Yeah, I'm a big fan of adding profitability to value. I mean, just empirically, it seems to work better and it's very logical. So, just as a review, value was the only factor that underperformed in 2024 by our measurement. If you look at the long short factor, it was the only one that's down on the year. Even if you only look at the long only legs, it was the only one that underperformed the market. So so just Q1 value, just cheap stocks returned about 10% last year in the Russell 1000. As compared to about a 13 or so percent return for the equal weighted Russell 1000. If you added some profitability to that, that increased the returns to about 15 to 16%. So, it outperformed the market if you just add that profitability component. To me, it's very logical because, sometimes value stocks are valued for a reason. They have a low, not good prospects and little chance for a turnaround. If you add a profitability filter to your value factor, you kind of filter out those value traps or, cheap companies that are cheap for a good reason. And that seems to work good both in the short term and the long term.
Oh, makes sense. So I think we'd like to introduce someone who's actually no stranger to quality, John Davi. John is founder, CEO, and CIO of Astoria Portfolio Advisors. John, thank you so much for joining us today.
Great to be here, guys. Thank you for having me on.
So before we get into talking about your investment process, can you tell us more about your start in the investment industry and what led you to start Astoria?
Sure. So I began as a quantitative derivatives analyst in Merrill Lynch's derivative research group in the late 90s. So I was an intern, basically spent my first 10 years kind of doing index level research, quant research, always at the index level. So that included like index futures, index options, ETFs, got popular in the late 90s. And so ETFs were underneath our research group. So then did that for 10 years. And then I became head of Morgan Stanley's ETF content for institutional clients. And, I had always liked macro research, asset allocation, and, I always wanted to join the buy side and be an entrepreneur. So I felt, here's a way to kind of do both, kill two birds with one stone, kind of join the buy side and also to, be an entrepreneur.
So let's talk a little more about Astoria. How would you describe the Astoria investment philosophy?
Yeah, so I would say, it's a combination of there's kind of two verticals, like two business lines. One is like quantitative research, and the expression could be like an SMA, a quant SMA, it could be an ETF, and then the other business line is kind of multi-asset ETF investing, um, kind of asset allocation. So really, I would say it's combining active and passive. That's kind of what we do, at our firm. I would say our ETFs are systematically active. It's very rules based. The implementation is active, like when we actually rebalance and how we trade. And I can spend a lot of time talking about that. But it's very kind of rules based, quantitative in nature. Our asset allocation is, I would say the idea there is that we want to use the business cycle, use earnings, valuations, use sentiment in order to kind of dictate whether or not we want to be overweight, underweight in asset class. And then we use a tiny bit of liquid alts in order to kind of hedge our left tail risk. Once you hedge the left tail risk, which I know we're in a bull market, but we've had many crises the last 7-8 years. So that ability to kind of hedge left tail risk, I think, is quite important. And just use like a little bit of liquid alts in order to kind of hedge that. So that's kind of like our two business lines. One is quant SMAs, ETFs. The other is multi-asset ETF model portfolios. And you asked me before, David, like, what do we fundamentally believe in? We definitely think that the more factors you can harvest in a portfolio, as long as you harvest in a low cost manner, and as long as you stick with the factors, like that historically has been able to give you higher risk adjusted returns and kind of put you higher up on the efficient frontier. So to summarize, start with like 10,000 investable stocks, filter down to 800 of the ones that are the largest, most liquid, good free float, and then pick 100 of that 800 that have, strong ROE, strong quality metrics that pay dividends, that are reasonably priced, that have a little bit of growth and momentum characteristics.
No, it's great. So let's focus in on quality for a second. What has your research shown about the long-term value of quality stocks?
Well, I liked what Chris said before. I mean, value and beta or value and quality, definitely have very, very low negative, very low correlations, if not negative, right? So if you believe in this concept of like, how do I get higher, on the efficient frontier? How do I mix factors? You're picking a factor quality that, has pretty robust long-term characteristics, and especially if you pair that with like value or you know small cap stocks, that looks very, very attractive to us. For us, at the end of the day, like, quality are companies that are robust, they pay dividends, they have good earnings, good ROI, ROIC, ROA, ROE. And it's this concept of like, it's persistent, pervasive, robust, it works across sectors, across countries, across economic cycles. And there is historical outperformance, right? So if you do some Fama French analytics, you'll see that high quality stocks have beaten low quality stocks and beaten the market over the last half a century, if not longer. I think their data set goes back to like 1963. So that's what we're looking for. I mean, these could be companies that Microsoft, Google, Facebook. I mean, a lot of them tend to be growth now, but it's brand hold names essentially. So that's how we think about it.
John, I talk to a lot of clients in my role, and when it comes to factor investing, I feel like the standard factors, most people have a very good definition, while it might vary somewhat of these factors, right? Things like value, things like momentum, things like low risk, right? You might have a different look back for your momentum factor per se, but we all understand what momentum is. Quality seems to be the one where people have differing definitions. It typically is a profitability metric, and then I've seen other things, and you just mentioned some of them. But like, when you think about a quality company, obviously you use profitability metrics like ROE, ROIC. Other than other factors, staying within the quality bucket, like what other things? Like, do you look at like things like stability of earnings or accruals or anything like that, when you're kind of defining your quality factor?
Yeah, we do. I mean, there's about five that go within the quality bucket, but as I try to emphasize, like, our ROE ETF is not just high quality stocks. Like, we're picking high quality stocks that have you know attractive valuations, that have good dividend paying ability, and that have a little bit of growth and momentum too. But yeah, I mean, in the end, though, within the quality bucket, it is skewed towards ROE, ROIC, ROA. But I think the point that I'm trying to articulate, and maybe I am, I need to do a better job, but if you have a good return on equity, a good return on asset, you are doing other things well in the company, like you're issuing dividends, you have good free cash flow, you don't use a lot of debt to equity, your leverage ratios are you know well allocated, let's say. So it does at times, Chris, like, feel a little bit fuzzy, because I think like value is just, okay, you're a stock that has a broken story and you need to have something to come corrected. The size factor, small cap stock, you're just, very small. Momentum is just, relative strength, very technical factor. So quality kind of encapsulates a few other metrics beyond just, the return on equity, return on assets. Some index providers and some ETF issuers will say, debt to equity is a big component of it within, the quality definition. For us, it's not. We tend to use more kind of traditional metrics like ROA, ROE, and ROIC.
Yeah, I totally agree with that. I mean, just based on my research, like you said, it's quality has sometimes a fuzzy definition, but it seems very clear to me that profitability is the most important part of quality. And when you look at back tests of all these different things, or accruals, or stability of earnings, or whatever, the ROE, ROIC, ROA back tests just perform much better. And I think profitability is really the backbone of quality in many respects. So another question I get from clients all the time, I'm kind of leading you to water here, but some clients that might not be as sophisticated in factor investing, they'll say things to me like, well, isn't quality just growth? Why don't you just use growth? Why do you use quality in addition to growth, or quality instead of growth? What would you say to that? Like, would you say, quality is like growth? How would you differentiate it? What would you say to that question?
So they're different. We happen to like combining both of them. We have an ETF, GQQQ, that's kind of quality growth stocks. It's like 50%, it's like half quality, half growth, let's say. Um, I would say right now we're in this kind of unusual period, Chris, where a lot of growth companies tend to also be in the quality bucket. It wasn't always the case. Um, but because tech stocks have produced such strong returns and they have good, earnings revisions, they have good growth estimates, good peg ratios. They also happen to have like strong ROE, strong ROIC, strong ROA. So they're in both buckets.
I've also found that quality is much better, sharp ratios, much better risk-adjusted returns, and I've seen that quality slash profitability is definitely not the same as something like low risk, but it does overlap with like low risk, low beta, low vol. You typically get similar stocks in there, and that also has very strong risk-adjusted returns. So the next question I wanted to ask you was something that's very interesting and something that I again talk to clients all the time about, and that is weighting your stocks, right? Like right now, just because of recency bias, it seems like any non-market cap weight, it's lagging. Customers come to me and say, why would you equally weight a stocks? Why would you have any other weighting scheme other than market cap weighting? Because market cap weighting has worked so well very recently. And, I know that when you go back far in time, that's not the case. So I would love to know your thought process behind why you weight your stocks, how you do, and maybe, you could dovetail into maybe some, concerns you could potentially have with the market cap weighted indices, how they're currently constructed.
I started my career in 2000, and it was basically the internet bubble erupted, and that was kind of like the impetus for like WisdomTree got popular, Rob Ernak got popular, AQR launched, and it was because market cap weighted indices were flawed because they had a lot of these tech companies. Some of them were profitable, some of them were not profitable, and really smart beta investing I think became popular because of the tech bubble and unwinding in 2001 2002. I feel like it's the same movie again. Although the difference is now is that a lot of these companies are actually pretty profitable. It's just that they're just gargantuan in size. I would say whenever I've done quantitative like stock selection, here at Astoria or my prior companies, like we always generally equally weighted, and it's like a risk mitigation tool. The more weight you give one stock, the more risk you take in that one stock. You know, Obviously now there's a big passive bubble, an ETF bubble, and money keeps pouring into like SPY, VU, IVV, and it's like this massive self-fulfilling prophecy because the costs are low. It's 2 basis points, 3 basis points, whatever it is. It works. People buy it. More money comes in. They buy the same stocks. So I would say now more than ever, it's important to tilt away. And we have like these decision trees, like when we run our multi-asset ETF strategies, like what do you want to tilt away towards? So I'll go that real quick. So basically, okay, like you tilt away from market cap, you can choose equal weight. That's one decision tree, but you have to be careful with equal weight, because how are you equally weighting it? And we could spend like 5 minutes talking about that. Do you want to tilt towards value? Okay, value is a factor that is very tough. It's very fickle. It works, every 10 years, maybe 2, 3 of the 10 years it works. So that's tough. Small caps, that's tough. You need the certain credit cycle, interest rate cycle for small caps to work. Then you have international. So the point is, like, if you have concerns about market weighted indices, people tend to lean on equal weight. You have to be careful with equal weight. I think equal weight, now has been tough, but like over like 20, 30 years, like you see that equal weight tends to outperform market cap. It works better out of like a recession. So when you cut it up, you'll see that like when you're like in this like economic slowdown, people buy more market cap weight, which I think is kind of this current period that we're in now. I sometimes hear people say, well, small cap equal weight's no longer going to work because companies staying private. But I just think we're in this like really unusual bubble of passive indexation, ETF flows, and market cap is just bid because just money keeps plowing into those products.
Yep, yep. I found the exact same thing. So what about like, and I typically stick to equal weight as well. I feel like it gets you like 95% of the way there. But like sometimes customers ask me, well, what about a more complicated scheme? Like what about some kind of inverse volatility weighting, like Ray Dalio style, right? Like risk parity, or maybe even more, like a mean variance optimization type weighting scheme. Like, do you find any value in those overly complicated ones, or do you think that's kind of adding more degrees of freedom to a model, which is generally bad?
I mean, to be honest, like it gets such a bad name, smart beta, but this idea of like weighting based on like quant metrics, like the higher the quant ranking, the more weight you give. Like we have some strategies where we do that. That to me makes sense and is like easier to explain. If you deal with institutional investors, totally get it. Mean variance optimization, inverse volatility, like I think you can do that and get away with it. But in the financial advisor world that I live in, RA world, like equal weight is enough tracking error versus the benchmark that, and it's easy to explain. I think you just have to be careful with equally weight. And um, like when you equally weight, let's say the Russell 1000 index, now you're talking about each stock is like 13 bip weight, let's say 12 bip weight. That's tough. If you equal weight S&P 500, each stock is 20 bips weight. We just like the reason why we launched ROE was because we weren't comfortable with S&P equal weighted ETF because there was only 15% technology exposure. So we wanted to kind of optimize our ROE ETF to match the S&P sector weight. So, and then we pick only 100 stocks. So now your marginal contribution to risk and return is a lot higher when you once you equally weight 100 stocks compared to like 500 or 1,000. And the other real extreme example is I put out a report called 10 ETFs for 2025, and I put in there this XNTK ETF. It's an equal weighted tech ETF from Spiders, and it's actually been the Qs over the last 3 years when we launched the report. And some people were surprised, but it's got 35 stocks. Each stock is 3% weight. And then it's not just like they pick stocks that have like strong sales and revenues. So it's a combination of like, smart beta. And then the mechanism to weight is like just a small concentrated portfolio, 35 stocks, 3% weight. So just have to be careful with equal weight. Even though it's simplistic, it's easier to like talk to advisors about that. It's like, how are you doing it and how are you optimizing the sectors?
So actually, you mentioned sectors, so I kind of want to touch on that a little bit. We've talked about weighting stocks, but how do you determine overweighting or underweighting different sectors? Are you looking at more macro, I guess, component issues, or
So in our quantitative stock selection SMAs and our ETFs, like we do track the benchmark sector weight. So we optimize against that. We want to have our stock selection provide the alpha and this concept that when we're designing it, we're doing a multi-factor. Um, when we're just doing like multi-asset investing in our ETF model portfolio business, we will overweight on the weight, and that's more based on macro top-down research, kind of like depending on where we are in the earnings cycle, the credit cycle, the inflation cycle. That's a much different game, sort of say. But when we're talking about like just quantitative investing, we'd rather have our stock selection in our quant code, which, for background, we have 5 CFAs on staff. My colleague Nick Serbone kind of oversees the quant side of it, and Pankaj Patel is kind of head of quant data science. I mean, collectively, these, the 5 CFAs, and we've got a lot of years experience building quant portfolios. Like, we know the code is very powerful, but we just stay diligent. We stick to our process. We do have risk management capabilities within that, which I can talk about. But I think when it comes to like quantitative, systematic investing, it's better to be like rules based, diligent, and stick with the process.
One of the things we do at BI that gets a lot of traction is monitoring the valuations of the factors. So what we typically do is we'll look at median valuations of the long and short side of the factors, compare them to each other, right? And I would say, like, is a long or short factor cheap or expensive? Now, I know that you said that value is part of your overall process, but just thinking about quality in and of itself, or really any other factor, to be honest, is there ever a scenario where like a certain factor gets too expensive historically, where like you might decrease the weight to it? Like, one of the things we've noticed recently is that profitability slash quality is very expensive. You can compare it to the market, you can compare it to low quality stocks. The ratio is very high historically, where the stuff is very bid up. Would that have any influence on the weighting of your factors?
It would, and that's where the power of being active and passive together and being kind of rules based, I think, is the benefit. So what I would say to you is like, okay, right now we've thought about this, but yeah, I think that's the flexibility that you can provide once you buy an active ETF or use an active manager. If you're just going out there buying like the quality ETF qual, you're going to be stuck with high quality stocks, let's say, especially if it's market cap weighted, which that is. For us, the minute you tilt away from market cap, you're going to get something that looks at a discount to the market. So, I would say the other main point to make here, Chris, is like each stock fights with one another in the quant ranking code, right? So if a stock got too expensive, eventually its ranking would fall down.
I wanted to ask about selling positions. So I understand it's a quantitative portfolio, and I know you're ranking the stocks. Is this done on a periodic basis, or is there anything that would kind of trigger a sell? In terms of rankings outside of that.
So, good question. I would say in anytime you equally weight, I think it's really important that you quarterly share change rebalance. Our code is longer term in nature, so it's not going to pick up like accounting fraud, let's say. So, in the case of like AppLovin, let's say, when we launched our G Triple Q ETF, it was like October 1st last year. Like in the case of like a Nasdaq 100 with like an annual rebalance, like Nasdaq added AppLovin in the December rebalance. I mean, it was up like 1,000% when they added it. These are things that you can look for and be a little bit more strategic when you're active, let's say. But again, like it's not going to pick up like an accounting fraud story. So like if we had an instance where a stock fell 20%, overnight, we would then do like the human bottoms up research and do like stock selection on that one stock to say, okay, you know, does this stock need to be kicked out? And I think that's a benefit of active. The extreme example I'll give you is like 10, 15 years ago, there was a stock in the FXI ETF that like just stopped trading because of like a fraudulent thing. And it stayed in the FXI ETF for like 6 months, right? Before it was kicked out. So like, there's benefits of doing both, right? Being rules based, which is more passive, and then being, using like an human oversight and kind of being active. But outside of these like very episodic periods, we generally don't have a lot of like intra-quarter sell signals, let's say, for our RO ETF. It is like an annual reconstitution process, but every quarter we bring the share change, the share weight back to 1%, and then we look at the quant code to see if anything materially deranked. And if it did materially derank, like a 1 or 2 decile became like a 8, then we would like investigate further. So that is a kind of like a risk management oversight.
Yeah, I was just going to piggyback off that with the risk management. Like I think about risk management as a couple layers, right? It's like diversification is one layer, and moving to equally weight does a lot for risk management in and of itself. And then you have individual position management, like do you stop yourself out of positions, which you kind of just spoke about. And then there's like I would call it like overall tactical risk management. Like, so is there anything like that? Like, would there ever be a scenario where you think the whole market's going down or went below its 200-day moving average or something like that, where you would like de-risk the whole portfolio? Is there any kind of tactical overall signals like that, or no?
Not in our SMAs and our ETFs. I mean, in our other business, multi-asset, ETF investing, like we do have the ability to kind of be much more flexible, which I can speak to. Um, I would say I just don't believe you can kind of time the market. So even if we were to de-risk the portfolio, it would be like us trimming like expensive US stocks to buy more value and or international and or using like more liquid alts. But like we wouldn't go more than, let's say 5-10% versus like its benchmark. So we kind of have like guardrails in place. um, I think that the thing I would tell a listener here is like, if you have a high conviction view, like you want to really de-risk your portfolio, you really have to have that kind of second line of thinking that like Howard Marks talks about. Like, what do you know that's not already in the price? And the one instance where we really had this huge high conviction idea was like during the inflation scare in 2022. And that was just us, thinking about economics 101, the M2 velocity of money. And we really did nail the inflation call. And we had some pretty significant outperformance versus our benchmark, past performance on indicative future results. But I think the last 2 years since that inflation scare, we've been mired in this like market cap, weighted bubble, passive, seven stocks driving most of the S&P, not really sure what's going on with, the market from a policy standpoint. So, we don't make any of those bets now. We just haven't had that view. Um, and then the only other point to really drive home is like, okay, why we're active is like, and I do have high conviction in this, is that my first job was like derivative research, like forecasting adds and deletes to like the S&P index, to Russell index. And I mean, I personally have a lot of friends that work at these hedge funds that arbitrage index flow. So I mean, let's say, the cash cows ETF has $30 billion. It's index based. You can basically know what stock's going to be added or deleted. And, you can like pre-position yourself. I felt strongly that any ETF that I was going to put my name next to would not be passive, just because I wouldn't want the street to front run my order flow to like, arbitrage net asset value points off the ETF. So what our ETFs, like, we just don't rebalance on the day of, triple witching, let's say. It's kind of like done, before, afterwards, and certainly could be intraday too.
Great. So we have one more question, and actually, it's funny you mentioned Howard Marks because my question is on books. I know his The Most Important Thing book is one of your favorites, might be your all-time favorite. But I was curious what other favorite financial books you have.
So I definitely think Larry Swedroe has written a lot of great books, and there's a very important concept that we definitely subscribe to, which is this idea that like, you know when you combine factors in a portfolio, you can get higher up in the first frontier. So, and he's got research that goes back, 70 years, 50 years. So basically, he says, okay, in this one table, if you do a 25% allocation towards the beta factor, the size factor, the value factor, and the momentum factor, the historical Sharpe ratio is like 0.74. And that's basically double any of the individual factor bets on either beta, value, size, okay. So then he says, okay, instead of doing 25%, do like 20% to each of those four factors. And then you add profitability as the fifth one. And you get a 0.96 Sharpe ratio. And then in the next iteration, he substitute quality for profitability. And now you got like a 1.1 Sharpe ratio. When you combine, five factors, you add profitability, you sub out profitability for quality, you're talking about almost triple the Sharpe ratio of any individual leg, beta, value, size. And then, like if he runs some analysis on like what's the underperformance odds over like a 1 year period, a 3 year period, 5, 10, 20 year. And your odds of you underperforming are dramatically lower when you combine factors. And so his book, everything you want to know about factor investing. I may be mistitling the book, but that book is kind of seminal to us. I'm a big fan of Buffett. He just releases, newsletter this weekend, and kind of what he preaches, like buying quality businesses, but just at a low price. I think that's real important to how we think about investing. So those are some of the top 2 or 3 that I would say resonate
Great.
with me.
Well, this is great, John. Thank you again for joining us today.
Thanks, guys.
And Chris, thank you for being my co-host today.
Thank you.
Until our next episode, this is David Cohne with Inside Active.